If you've noticed that the hotel you're considering booking for your upcoming summer vacation is more expensive than last year, or that your grocery bill has increased despite the fact that you're purchasing the same amount of food, you're witnessing the effects of the country's recent inflation surge. While the recent increase in costs for products and services has been mostly linked to the global reopening, we have no idea how long it will persist or how we should respond financially. For the average consumer, rising costs may mean restricting extravagant spending in order to prevent a significant blow to the pocketbook. However, if you are an investor, you are probably more worried about your money losing value in the market. While banks may convince us that our money is secure with them, the reality is that it is not. While cash is secure from robbers and thieves, one thing is continually eroding its value: inflation. As you recall from your high school economics classes, inflation is essentially the progressive reduction in the buying value of a currency caused by rising demand and stable supply. To combat inflation, a person must learn to invest. Are you at a loss as to where to begin? Simply follow these straightforward guidelines. To begin with, what is inflation? In economics, inflation is a quantitative term that refers to the rate of change in the prices of a standardized bunch of products. Inflation is defined as a rise in prices over time, given as a percentage rate. The Consumer Price Index, or CPI, the Producer Price Index, or PPI, and the Personal Consumption Expenditures, or PCE, price index are the most often used economic data for measuring inflation. The Federal Reserve's chosen inflation indicator is the PCE price index. The PCE is a wider measure than the CPI and is weighted differently to it, since it is based on consumption indicators used to calculate gross domestic product rather than on a household expenditure survey. Here are 9 tips on how to invest during inflation. Be sure to stay tuned until number 9, because it is a game changer. Number 1, get started early. A well-known remark among successful investors goes, "The optimal moment to grow a tree was more than 2 decades ago. Now is the second best time." This quote encapsulates the first rule. To combat inflation, we really have a quite potent weapon at our disposal: compound interest. When compound interest is calculated, the number of years the money has been invested has a greater influence on the resultant value than the principal amount invested. The message is straightforward: begin investing as soon as possible and continue investing for as long as possible. Number 2, maintain an informed position. Even Warren Buffett would agree that the greatest investment is time spent acquiring information. Beating inflation is not an easy undertaking by any means, but it may be simplified significantly if one knows what they are doing. Before investing your hard-earned money in the stock market, real estate, cryptocurrencies, or pretty much any other type of investment, you should educate yourself on the fundamentals, because if you are unsure of what you are doing, then you shouldn't do it. Number 3, ensure that your portfolio is diverse. A common rule of thumb is to never put all your eggs in one basket, and this is as true with investing as it is in everyday life. Diversifying your portfolio is an excellent method to mitigate the risks associated with investing. Bear in mind that inflation is not your only adversary. Your assets' volatility is as well. By diversifying your holdings among equities, bonds, real estate, and gold, you'll always have something to fall back on if things don't work out as planned. Number 4, the 50-30-20 success formula. While there are several budgeting rules and techniques available, the 50-30-20 rule is one of the most popular among beginner and intermediate investors. According to this guideline, you must set aside 50% of your earnings or income for basic necessities, which include rent, bills, food, and maintenance. Following that, allocate 20% of the leftover funds to your financial objectives. Simply put, invest it in the varied portfolio discussed earlier. Finally, 30% of the total is for wants. After all, don't you deserve to have some fun as well? Number 5, invest in real estate. Real estate income is revenue generated through the leasing out of a property. Real estate is a good hedge against inflation. This is because when inflation increases, property values and the amount a landlord may demand for rent increase as well. This leads to a better rental revenue for the landlord over time, which helps in keeping up with the rate of inflation. As a result, real estate income is one of the most effective strategies to protect an investment portfolio against inflation. As with any investment, real estate has a number of advantages and disadvantages. To begin with, the transaction expenses associated with acquiring real estate are much greater as compared to purchasing shares of a stock. Second, real estate assets are illiquid, which means they cannot be sold fast or readily without suffering a significant loss in value. If you purchase a home, it will need administration and upkeep, which may rapidly add up. Finally, real estate investment entails significant financial and legal risks. Number 6, make an investment in gold. Historically, gold has been seen as a hedge against inflation. Indeed, many people have seen gold as an alternative currency, especially in nations where the domestic currency is depreciating. When their own currency fails, these nations often rely on gold or other stable currencies. Gold is a tangible, physical item that, for the most part, retains its worth. Gold, on the other hand, is not a perfect hedge against inflation. When inflation increases, central banks often tighten monetary policy by raising interest rates. Owning an asset such as gold that pays no interest is not as useful as holding an asset that does, much more so when interest rates are higher, implying larger yields. Despite that, gold has traditionally been a great inflation hedge since its price tends to grow in lockstep with the cost of living. Over the last 50 years, investors have seen gold prices skyrocket and the stock market crash amid periods of rising inflation. This is because when fiat money's buying value is eroded by inflation, gold is often priced in those currency units and therefore emerges with everything else. Additionally, since gold is seen as an excellent store of value, individuals may be enticed to purchase it when they perceive their local currency is losing value. Gold has always been a preferred metal for inflation protection. Due to the fact that gold prices fluctuate in lockstep with inflation, investing in gold increases your chances of improving your buying power via prospective investment returns. While holding actual gold is ideal, it might be difficult to acquire owing to its higher entrance barrier. However, gold ETFs make gold more accessible. Investors should begin by locating a reputable gold exchange-traded fund with a track record. Number 7, consider TIPS. TIPS, or Treasury Inflation-Protected Securities, are an excellent strategy to hedge your government bond holdings if you anticipate inflation will accelerate. These U.S. government bonds are inflation-indexed, which means that if inflation increases or decreases, the effective interest rate paid on TIPS will also increase or decrease. TIPS bonds pay interest on a semi-annual basis and are available in maturities of 5, 10, and 30 years. Due to its backing by the United States federal government, as is the case with other government debt, they are regarded as one of the safest investments in the world. Number 8, take I bonds into consideration. Series I savings bonds, more often referred to as I bonds, are another kind of government-issued security aimed at beating inflation. As with TIPS, they protect the buying power of your money by making periodic rate adjustments depending on current inflation. Unlike TIPS, they do not adjust the par value of your bond. Rather, they adjust interest rates every 6 months in accordance with current inflation. That might be rather advantageous for you these days. Interest rates will remain over 7% at least until April 2022. However, interest rates on I bonds fluctuate regularly and sometimes reach zero. This implies that although you are assured not to lose your original investment, it may be eroded over time as a result of inflation if interest rates decline. Additionally, I bonds have rather lengthy lock-in periods. You cannot cash out an I bond until at least a year after purchase, and for the following 4 years, you will be penalized with 3 months of interest if you do, similar to a certificate of deposit. Number 9, make a commodity investment. Commodities are another viable inflation hedge. These include crude oil, natural gas, precious metals, wheat, and maize. They may be exchanged on the futures market, which allows for the purchase and sale of commodities futures contracts at a specified future date. Commodities are intrinsically anti-inflationary. As inflationary pressures support prices, commodity prices will rise as well, providing investors with a positive return on their investments. Prices often rise in lockstep with rising inflation, which means that those who invest in them will benefit from growth that is commensurate with the rising expenses of goods and services. Given the commodities market's volatility, experts advocate investing in commodities via a diversified investment vehicle, such as a mutual fund or exchange-traded fund. When deciding how much of your portfolio to dedicate to commodities, investors should consider diversification, since we never know which commodity will outperform. It's all about the way the investments interact. Typically, investors do not want to rely too heavily on any single asset type. Perhaps 5% makes sense for someone who is more conservative. For someone who is more aggressive, they can work their way up. How do you plan to beat inflation? What else would you like us to talk about in our upcoming videos? Let us know in the comments below. And make sure to subscribe and turn on notifications so you don't miss out on any of our videos.